The phone rang at 7 in the morning, and Margaret Calloway already knew the market had moved against everything that man had predicted. She did not rush to answer it. She set her chamomile tea down on the kitchen table, smoothed the page of her notebook with the flat of her hand, and looked at the numbers she had written at midnight. She had been right. She had been right for the 14th time in a row, and the man on the other end of that phone had been wrong for the 14th time in a row. And yet, he was the one with the framed certificates on his office wall, and the company car in the parking lot, and she was the one people assumed had come in to pick up her grandson. Margaret, who went by Meg to everyone who actually knew her, was 53 years old when she walked into Hartwell & Associates for the first time. She wore a plain gray cardigan and carried a thermos in one hand and a green notebook in the other. The notebook had tabbed sections, color-coded annotations in 3 different pen colors, and margin notes so dense they had begun to spill onto the back covers. The thermos smelled like chamomile and honey. The receptionist, a young woman named Claire who had worked the front desk for 2 years and prided herself on reading people well, looked up from her monitor and smiled the kind of smile that contained an assumption. She asked Meg if she could help her find someone. Meg told her she had an appointment to open a self-directed investment account. Claire blinked once, recovered professionally, and asked her to take a seat. What happened in the 40 minutes Meg waited in that lobby said everything about the world she was stepping into. 2 men in suits walked past her without glancing at her. A junior analyst held the door open for her as he left for lunch and seemed surprised when she did not follow him out. A woman in heels who was clearly someone important strode past, talking into her phone, and did not register that Meg existed at all. Meg sat with her notebook open on her lap, calmly reviewing her entry positions for the week, and she noticed all of it. She had spent 53 years being underestimated. She had learned a long time ago that being underestimated was not a wound, it was a tool. The account she opened that morning carried $40,000 in it, not borrowed, not inherited, not the result of a lucky tip or a one-time windfall. It was money she had grown herself, quietly and deliberately, over 4 years, starting from $8,000, using a strategy she had built from scratch, by reading everything she could find, and then testing it, failing at parts of it, adjusting, and testing again. She had not told anyone in her family what she was doing while she was doing it. She had not posted about it online. She had not joined a group or attended a seminar or paid for a course. She had gone to the library, and she had read. And then she had gone home and she had read more. And then she had opened a practice account, and she had traded on paper for 8 months, before she ever risked a single real dollar. The advisor who processed her paperwork that morning was not Theodore Hargrove. It was a quiet young man named Peter Sloan, who was new enough to the firm to still treat every client with the same careful attention. He walked Meg through the account terms, explained the platform, and asked her a few questions about her investment experience. When she answered him in specific, technical language, he paused for just a moment, recalibrated, and continued with noticeably more respect. He would later tell Priya, the junior analyst who sat 2 desks away from him, that he had rarely seen anyone come in with that kind of preparation. Priya would file that comment away, without knowing yet how important it would become. Meg drove home that afternoon, with the account confirmation in her bag, and the radio off. She liked the silence on long drives. It gave her room to think. She was thinking about a mid-size manufacturing company based in Ohio that had been on her radar for 6 weeks. The company had low debt, strong cash flow, a management team that had been quietly buying their own stock for 3 consecutive quarters, and a share price that had been beaten down by temporary sector noise that Meg believed would clear within 4 to 6 months. It was exactly the kind of company that excited her. Not flashy, not talked about, not on any list that people passed around on financial social media, just quietly, fundamentally sound, and being ignored by everyone who should have been paying attention. She made the first trade from her kitchen table the following Monday morning, with her tea beside her and her notebook open to a fresh page. She bought the position in 3 equal parts over the course of the week, which was how she always entered anything she believed in. She did not rush. She had never been a person who rushed. Her mother had called her deliberate when she was small, and she had taken it as a compliment even when it had not been meant as one. To understand Meg fully, you had to understand where she had come from, and where she had come from was not a place that offered many shortcuts. She had grown up in a small town in Vermont, where money was talked about in hushed tones, and the idea of a woman managing investments was not discussed at all, because it was not considered a possibility. Her father had worked at a paper mill for 30 years. Her mother had cleaned houses and taken in sewing. There had been enough to eat and enough warmth in winter, but there had never been extra, and the concept of extra had always felt to Meg like something that belonged to other people in other places. She had married at 26. Her husband, a kind and steady man named Gary, worked as a high school teacher and coached track on the side. They had 2 children, a son named Daniel, who now lived in Portland and worked in software, and a daughter named Caroline, who had moved to North Carolina after her own marriage and ran a small catering company with her husband. It was not a wealthy life, but it was full and warm and honest, and Meg had never once wished it were something other than what it was. Gary had gotten sick when he was 58. It started as something the doctors described as manageable, and then it became something else. And then 18 months after the first diagnosis, it was over. He was 60 years old. Meg sat in the hospital room the morning after he died and held his hand, even though he was no longer there to feel it. And she thought about all the things she had never told him she was afraid of. Money was one of them. Not because she was careless with it, but because she had always depended on the steadiness of their combined income, and now half of that steadiness was gone. The life insurance policy covered the medical debt and left her with $8,000. The pension she received from Gary's years of teaching was small. The house was paid for, which was the one solid ground beneath her feet. Daniel and Caroline both offered to help. She told them she was fine. She was not entirely fine, but she was not someone who said that out loud to her children, because she did not want them to rearrange their lives for her. She wanted to figure it out herself. She always had. The library was a 15-minute drive from her house. She started going every Tuesday and Thursday. She told her neighbor she was working on a project. Her neighbor assumed it was a quilt or a garden plan. Meg let her assume that. She checked out books on personal finance first, the basic ones. The ones that explained compound interest and asset allocation in plain language. She read them at the kitchen table with a pen in her hand, underlining things, writing questions in the margins. Then she moved to books on value investing, on reading balance sheets, on understanding earnings reports. She moved through them steadily, the way she moved through everything, without rushing, without skipping ahead to the exciting parts before she understood the foundation. 4 months in, she found a book that a retired fund manager had written about his 40 years of reading company financials. It was not a well-known book. It had a forgettable cover and a dry title, and she nearly put it back on the shelf. Instead, she sat down in one of the library's reading chairs and read the first 3 chapters without moving. By the time she drove home that evening, something had shifted in the way she understood what she was looking at. Numbers were not just numbers. They told stories. A company's balance sheet was a kind of biography, and if you knew how to read it carefully, it would tell you things that the headlines and the analyst reports and the market noise never would. She opened the practice account in month 5. It was a simulated trading platform she had found through an online search, free to use, where she could place trades with virtual money and track them in real time. She treated it exactly as she would have treated real money. She kept a record of every decision she made and the reasoning behind it. She noted when she was right and, more importantly, when she was wrong, and she spent longer studying her mistakes than her successes. The mistakes were more useful. They showed her where her thinking had been lazy, or impatient, or influenced by something she had read online, instead of something she had found herself in the numbers. 8 months later, she took the practice account results, spread them across her kitchen table, and reviewed them honestly. She had made a return of 31% over those 8 months, with 2 significant losses that she had recovered from cleanly. She had learned something from every single trade. She looked at those pages for a long time, alone in her kitchen, with the windows dark and the house quiet, and she made a decision. She was going to do this with real money, not money she could not afford to lose, but real money, because she had earned it, and because the numbers told her she was ready, and because she had never in her life waited for someone to give her permission to try something. By the time she walked into Hartwell & Associates with $40,000 and opened her account, she had already grown the original $8,000 into that sum through a careful combination of 2 strong stock picks and 1 decision to hold a position through a period of volatility that would have caused most new investors to sell in a panic. She had not panicked. She had gone back to her research. She had confirmed that nothing fundamental had changed about the company. She had held. and the market had eventually agreed with her. She did not celebrate. She made a note in her green notebook, recalculated her next target, and went to bed at a reasonable hour. What she did not know, sitting in that lobby with her thermos and her notebook and her quiet certainty, was that in an office down the hall, a man named Theodore Hargrove was about to notice her account on the system and make a remark that would follow both of them for a very long time. She did not know his name yet. She did not know anything about him. She was simply a woman who had come in on a Tuesday morning to do something she had been building toward for 4 years, and she was not interested in what the room thought of her. She had long since stopped waiting for rooms to decide what she was worth. She signed the final page of the account paperwork, thanked Peter Sloane with a handshake, and walked out through the glass doors into the sharp morning air. She had things to do. The Ohio Manufacturing Company needed one more review before she committed to the second tranche of her position. There was a quarterly report due on Friday from a logistics firm she had been watching, and she had left the tea on the stove at home, which meant she needed to start a fresh cup when she got back. She drove home with the radio still off, the account confirmation sitting in her bag, and the kind of stillness inside her that comes not from nothing being at stake, but from knowing exactly what you are doing and why. She had no idea, yet, that the man who had already dismissed her with a laugh was about to watch her outperform him in every way that mattered. She had no idea that his dismissal would become a story people told. She had no idea that by autumn, he would be standing in front of her, asking for her help. She just knew the numbers. And the numbers, as they always did, told the truth. Gary Calloway had taught his students that the most valuable thing a person could do with a piece of information was to ask what it was connected to. He used to say it in the classroom when he introduced a new topic, and he said it at the dinner table when one of the kids came home with a problem they could not solve. Everything is connected to something, he would say. Pull one thread and see what follows. Meg had spent 30 years listening to that without realizing she had absorbed it completely. It was only after he was gone, sitting at her kitchen table with a library book about balance sheets and a cup of cooling tea, that she understood she had been using his method all along. She just had not been applying it to money. The year she started teaching herself to invest was the loneliest year of her life. Not because she did not have people around her. Daniel called every Sunday evening, always from the couch she had never seen in his Portland apartment, his voice familiar and slightly too careful, the way it always was when he worried about her. Caroline called twice a week and filled the calls with news about her children and her business and the small dramas of her neighborhood in a way that Meg knew was meant to fill space so that the silence could not sit between them. The neighbor, a woman named Harriet who had lived next door for 20 years and fed her cats with a kind of devotion most people reserved for children, appeared at the door twice a week with something she had made too much of: soup, biscuits. Once, inexplicably, an entire tray of stuffed mushrooms. Meg appreciated all of it. She was not lonely because she lacked company. She was lonely because the version of herself she was becoming did not have anyone to talk to yet. She could not explain to Daniel what she was doing without him worrying that she was making a mistake with the only money she had. She could not explain it to Caroline without it becoming a conversation about whether she needed more help than she was admitting. She could not explain it to Harriet at all, because Harriet's understanding of investment was limited to a savings account her late husband had maintained at the credit union, and she considered that perfectly sufficient. There was no one in Meg's immediate world who could sit across a table from her and say, "Yes, that balance sheet tells me the same thing it tells you." There was no one to think out loud with, so she thought alone, and she wrote it all in the notebook, and the notebook became the closest thing she had to a conversation partner for a long time. The first real test came 7 months into her self-education, before she had even opened the practice account. She had been studying a retail company that the market had heavily punished after a disappointing quarterly report. Most of the commentary she found online was dismissive. The company was described as outdated, poorly managed, behind the curve. Analysts were downgrading it in clusters. The share price had dropped 34% in 6 weeks. On the surface, it looked like exactly the kind of company a sensible person would avoid. Meg read the quarterly report herself. She did not read the summaries. She read the actual document, line by line, the way she had read everything since starting this process, with her pen moving steadily and her notebook open beside her. What she found did not match the narrative she had been reading online. The company's core operations were generating strong cash. The loss they had reported was connected to a one-time write-down on a division they were already in the process of closing. The management team had not sold a single share in the previous 12 months. In fact, 2 of the directors had bought additional shares the week after the price fell. The debt was low. The inventory was under control. The customer base, according to a metric Meg had learned to track through her reading, was actually growing modestly in the company's strongest geographic markets. She wrote 4 pages of notes. She built a simple model on a sheet of graph paper, estimating where the cash flow would likely land over the next 2 to 3 years if the company continued along its current trajectory. She checked her assumptions 3 times. Then she sat with it for a week, not touching it, letting the initial enthusiasm settle so she could look at it again with colder eyes. A week later, she looked at it again. It still told her the same story. She did not have real money in the market yet, but she noted the company, the price, and the date in her notebook with a small star beside it. 14 months later, she went back and checked. The share price had recovered fully and gone on to gain an additional 40%. The retail company had closed the troubled division cleanly, returned to profitability, and been acquired by a larger firm at a premium. Every data point she had identified had played out, not perfectly, not on the exact timeline she had estimated, but in the direction and for the reasons she had found in the numbers. She sat with that open notebook for a long time on the afternoon she checked, not gloating, not triumphant, just absorbing the confirmation that the method worked, that she could read what was really there, beneath the noise and the short-term panic and the loud opinions of people who had not read the actual document. She could see what they were missing, and that was not an accident. It was a skill she had built, deliberately, 1 book at a time, 1 page at a time, in her kitchen in Vermont, with a cooling cup of tea, and no one watching. The practice account opened 6 months after that retail observation. She approached it with the same seriousness she had brought to every phase. She built a watch list of 12 companies she had researched thoroughly. She did not trade all 12 at once. She picked the 3 she was most confident in and began there, spreading her virtual positions over time rather than buying all at once, because she had read enough to know that trying to time the perfect entry was a form of arrogance the market consistently punished. The first 3 months of the practice account were not spectacular. She made modest gains on 2 positions and took a small loss on 1 when a company she had believed in reported earnings that missed her estimates for reasons she had not anticipated. She went back through her notes on that position and spent 2 evenings working out exactly where her analysis had gone wrong. She had weighted 1 data point too heavily and dismissed a warning signal in the inventory numbers that, in retrospect, she could see clearly. She wrote the lesson down. She did not make the same error again. By month 5 of the practice account, she had found her rhythm. She was not a frequent trader. She might make 3 or 4 moves in an entire month. She let positions breathe. She had learned, through reading and through the practice account, that the biggest enemy of a good investment was the investor's own impatience. People sold things that would have made them wealthy if they had held on, because the waiting made them anxious, and anxiety made them interpret ordinary short-term market movement as a sign that they had been wrong. When a position moved against her, her first question was never what should she do. Her first question was whether anything fundamental had changed about the company. If the answer was no, she held. This discipline would define her more than anything else. It would become the single most visible difference between her approach and the approaches of people who had far more formal training and far more experience and far more confidence. They reacted. She did not. They adjusted to the noise. She ignored the noise and went back to the numbers. By the time she concluded the practice account after 8 months and tallied the results, she had produced a return that startled her a little. Not because she thought she had gotten lucky. She knew she had not gotten lucky. She knew exactly why every position had moved the way it had, because she had tracked it, questioned it, and understood it. What startled her was the distance between what she had produced and what she had heard people with formal investing experience describe as a good year. She had outperformed the broad market index meaningfully over that 8-month period, and she had done it with a strategy built entirely on patience and reading and honest self-assessment. She folded the practice account results into a sleeve at the back of her green notebook. She did not show them to anyone. She made her decision. moved the $8,000 into a brokerage account she had already researched and selected for its low fees and clean platform, and she began. The first real trade, executed with real money, felt nothing like she expected it to feel. She had expected some kind of adrenaline, some heightened sensation. Instead, she felt calm. She had done this before. The money was real this time, but the process was exactly the same, and the process was what she trusted, not the outcome. The outcome would follow if the process was sound. She had tested the process. She knew it was sound. Over the next 4 years, she made 31 trades. She held some positions for less than 3 months. She held others for over a year. She had 4 losses, 2 of them modest and 2 of them meaningful enough to require honest reassessment. She learned from each one. She never let a loss become a story she told herself about being wrong or being unlucky. A loss was data. It meant something had not gone the way the analysis suggested, and it was her job to find out what she had missed and not miss it again. By the time she walked into Hartwell and Associates and sat down across from Peter Sloan with her thermos and her green notebook, the $8,000 had become $40,000. She had not told her children. She had not told Harriet. She had not told anyone. She was not secretive by nature, but she was deeply private about things that were still in progress. The work was still in progress. The $40,000 was not the destination. It was a point on a road she intended to stay on for a long time. What she was about to find out was that entering that firm was not simply a practical step. It was the moment her private world would begin, slowly and then all at once, to collide with a public one. It was the moment someone would say something careless and dismissive and unkind, and it would find its way back to her, and she would make a choice about what to do with it. She would not make a dramatic choice. She would not make a loud one. She would make the same kind of choice she always made. She would go home, look at the numbers, and keep going. That choice would cost her nothing, and it would eventually cost Theodore Hargrove something he valued far more than money. It would cost him the comfortable certainty that he already knew everything he needed to know. Theodore Hargrove had been performing since he was 9 years old, not on a stage, in rooms. He had discovered early, with the instinctive precision of a child who pays close attention to what makes adults respond, that confidence was currency, not the quiet, earned kind, the loud, displayed kind, the kind that walked into a space and immediately suggested it owned that space, the kind that laughed easily and made other people feel that being near it was a small privilege. He had been doing it for so long that he was no longer sure which parts of it were deliberate and which parts had simply become him. He was 41 when Meg Calloway's account appeared on the Hartwell and Associates system. He had been with the firm for 12 years and had been its top-performing advisor for 7 of them. His client portfolio was worth just under $40 million in managed assets. He drove a car the firm leased for him. He had a corner office with a window that faced the street, which in a building where most offices faced other offices was a meaningful status signal. His name appeared on the firm's promotional materials with the word distinguished next to his title, a word that the marketing team had suggested and that he had not discouraged. He was good at his job. That was important to say clearly. He was not a fraud. He knew the market. He knew how to talk to wealthy clients in a way that made them feel both informed and reassured, which was rarer and more valuable than most people in the industry wanted to admit. He understood risk management at a theoretical level and executed it competently at a practical one. He had guided his clients through 2 significant market downturns in his career, with a steady hand and clear communication, and very few actual losses that required explanation. But there was a difference between being good and being exceptional, and Theodore, for all his confidence, had never quite crossed that line. His returns were consistently solid. They were rarely surprising. He did not find things other people missed. He found the same things other people found, slightly faster, and executed them slightly more cleanly. That was a real skill. It was not the only skill. He had also, over 12 years, developed a way of looking at the world that was organized around a set of assumptions he had stopped questioning. One of those assumptions was that the world of serious investing had a certain kind of occupant, young to middle-aged, formally educated, probably male, though he would never have said that out loud in the current environment, connected, credentialed, fluent in the language, someone you could identify in the first 30 seconds of a conversation. He would not have articulated this assumption if asked. He would have said, if pressed, that he believed in merit and performance, and that results were results regardless of who produced them. He might have believed that about himself. But belief and behavior are not always the same thing, and his behavior on the morning he pulled up Meg Calloway's account told a cleaner story than his beliefs did. He had been walking through the shared system area near Peter Sloane's desk, looking for a report that had been misfiled, when he noticed a new self-directed account that had come in that morning. He glanced at the initial deposit, $40,000. Modest, not unusual for a self-directed account. Then he looked at the trading history that had been transferred in from her prior brokerage. His eyes moved quickly down the list. He was a man who could read a string of numbers fast and accurately, and what he saw made him pause. The positions were not random. They were structured. There was a pattern of holding periods that suggested discipline rather than guesswork. The returns on the closed positions were, several of them, quite good. He looked at the account holder's name, Margaret Calloway. He looked at the age field, 53. He looked at the occupation field, which she had filled in as retired. Something shifted in his face, not dramatically, just a small movement, the kind that happens when a person's brain reaches for the nearest available category and locks a new piece of information inside it. He called over to a colleague, a man named Frank, who had been with the firm for 9 years and shared Theodore's general view of the world without being quite as polished about it. He tilted the monitor slightly. He made a comment. He said, with a small laugh, that some retired woman was playing at stocks and that someone should probably tell her to stay with her crochet instead. Frank laughed. It was not a loud or particularly mean laugh. It was the laugh of someone who finds a small thing amusing because they are not thinking very hard about it. The comment drifted out into the open office the way careless things do, and settled into the air without anyone seeming to notice. Except Priya Okafor noticed. Priya was 27. She had been at the firm for 14 months. She sat 2 desks away from Frank, close enough to have heard the comment clearly. She was working on a client summary, and she kept her eyes on her screen. But she felt the comment land somewhere in her chest, in a way that made her go very still for a moment. She did not say anything. She was junior enough to know that saying something in that moment would cost her more than it would solve, and she had not gotten where she was by making expensive mistakes. But she did not forget it either. She filed it away in the part of her memory where she kept things that mattered. She had seen Meg Calloway in the lobby that morning. She had noticed her because Meg was not the kind of person this firm's lobby usually contained, not because of how she was dressed or what she carried, because of how she was sitting. Most people in waiting rooms looked either impatient or anxious. Meg had looked absorbed. She had her notebook open on her lap, and she was writing in it, not scrolling, not checking her phone, writing. And her face had the expression of someone working through something interesting, rather than someone enduring a delay. Priya had found that interesting enough to notice. Most things worth noticing were quiet things. Now she knew who this woman was. She knew what Theodore had said, and she sat with both of those pieces of information for the rest of the morning, turning them over without yet knowing what she was going to do with them. Theodore, meanwhile, had moved on. The comment was already gone from his mind before he had reached the end of the hall. That was the thing about careless dismissals. The person who made them did not hold them. They did not need to. They had already gotten the small satisfaction the comment provided and moved on to the next thing. The person on the other end was the one who carried it. In this case, that person was not going to carry it in the way Theodore would eventually learn, to his considerable discomfort, that he should have anticipated. Because Meg Calloway, who had driven home from the firm that afternoon with her account confirmation in her bag, and her mind already on the Ohio manufacturing company she was planning to review, did not yet know what had been said. She would find out, but not for 2 weeks, and by then she would already have made her first trade from the new account, and it would already be performing exactly as her research had told her it would. The remark, when it reached her, did not arrive as a dramatic revelation. It arrived the way most important things arrived in Meg's life, quietly, through a person who was treating her with ordinary human decency. Priya had found a reason to mention it, briefly and without embellishment, during a short phone call she made to check that Meg's platform access was working correctly. She had said it simply. She had said she was sorry that it had been said. Meg had thanked her, genuinely and without performance, and the call had ended. She stood in her kitchen for a moment after the call. She looked at the counter, where her green notebook was sitting open to the page, where she had been recording her research notes on a new position in a logistics company she had been following. She thought about the comment. She thought about the man who had made it, whoever he was, and the ease with which he had made it, and the fact that he probably could not recall it even now. She thought about all the rooms in her life where she had been that woman, the one someone had already decided about before she opened her mouth, the one whose competence was invisible by default and had to be proven before it would be acknowledged, and sometimes not even then. She picked up her pen. She went back to her notes on the logistics company. She was tracking a potential entry point. The numbers needed to settle. She needed to be patient. She was always patient. What she was building was not a response to Theodore Hargrove. It had nothing to do with him. It had been building for 4 years before she knew his name existed, and it would have continued building in exactly the same direction if she had never heard the remark at all. But the remark had a quality she recognized. It was the kind of thing that, when said about a person, either defeated them or clarified them. It forced a decision about who you were going to be in relation to the opinion of someone who had already made their decision without looking. Meg had made her decision a long time ago. She had made it at a library table with a book about balance sheets and a pen running out of ink. She had made it the night she sat alone with the practice account results and understood what they meant. She had made it on every morning she got up before the market opened and reviewed her notes instead of reading what someone else thought. She was not going to change her direction because a man in an office had laughed at the idea of her. She was going to continue exactly as she had been continuing, because the direction she was moving in was correct, and she had the numbers to prove it to herself, which was the only proof that had ever mattered. Outside her kitchen window, Vermont was moving into the pale gold of early autumn. The trees had not turned yet, but they would soon. She could feel the season shifting in the quality of the light. She finished her research notes, closed the notebook, and went to make a fresh cup of tea. There was work to do. Priya Okafor had wanted to be the kind of person who said something in the moment. She had rehearsed, in various ways over the years, the version of herself who spoke up calmly and directly when she witnessed something that was not right. In the rehearsal, the words came out measured and clear, and the room paused and took notice, and things were better afterward. In real life, on the morning she heard Theodore's comment about Meg Calloway's crochet, she had done the calculation that every junior person in every professional environment does when they witness something they should not stay silent about. She had done the calculation in about 4 seconds, and she had stayed silent. Not because she was a coward, because she was strategic, and because she had already learned that institutions do not reward the junior employee who corrects the senior one in front of an audience. They absorb the correction and then they find quiet ways to make the junior employee pay for it later. So she had stayed silent. But she had not stayed indifferent, which was a different thing entirely. Priya had grown up in a household where her father, an engineer from Lagos who had rebuilt his career from scratch after arriving in England in his late 20s, had described the experience of being underestimated as something you could either consume or convert. He said it once at the dinner table when Priya was 14, and had come home furious after a teacher had publicly doubted whether she would be capable of taking the advanced mathematics class. Her father had listened to the whole story. Then he had said, very calmly, that the teacher's doubt was information, and information was always more useful than emotion. He asked her what she was going to do with it. She had won a regional mathematics competition 6 months later. She had not done it to prove the teacher wrong. She had done it because she understood something after her father's question that she had not understood before, which was that other people's underestimation was not a verdict. It was a starting position. She thought about her father on the afternoon she called Meg Calloway to check on the platform access. She had used the check-in as a clean professional reason to make contact without it seeming like anything more than it appeared to be. She mentioned the remark briefly, at the end of the call, after the practical part was done. She said it plainly. She said she was sorry. She meant it. Meg had been gracious, in a way that suggested she was neither crushed nor enraged, which Priya found interesting. Most people landed in one of those two places when they heard something that had been said about them. Meg sounded like someone who had filed it cleanly and was already moving on. After the call, Priya went back to work. She had a client summary to finish and 2 account reviews due by the end of the day. She was competent and fast, and she consistently produced work at a level that her supervisors noticed and occasionally praised, without ever quite knowing what to do with, because praising her more concretely would involve accelerating a trajectory that moved faster than the firm was entirely comfortable with. She knew this. She had known it since the end of her first year. She did not let it make her bitter. She let it make her precise. Every piece of work she produced was airtight. Every number she reported was checked twice. She never gave anyone a reason to question her output, but she watched. She was an extremely good watcher. And what she was watching over the weeks that followed Meg's account opening was something she found genuinely absorbing. She had access, as part of her role supporting the account management systems, to performance data across the firm's client accounts. Not detailed client information, aggregate return data, and comparative benchmarks. It was part of her job to pull this data for the quarterly review reports she helped prepare. She began to notice, by the end of the first full month, that Meg's self-directed account was showing returns that were not only positive, but structured in a way she recognized. There was a quality of deliberateness in the movement. Positions were being added in tranches. Holdings were being maintained through short-term volatility. The account was not doing what most retail self-directed accounts did, which was react constantly and expensively to short-term market movement. She noted it. She did not mention it to anyone. Not yet. Meanwhile, in his corner office with the window that faced the street, Theodore Hargrove was having a productive autumn by the metrics he cared about. He had signed 2 new clients in September, both mid-sized business owners who had come to him through referrals. He had restructured a portfolio for a long-standing client who had been nervous about interest rate exposure, and the restructure had gone smoothly. He played golf on Saturdays with 2 of the firm's senior partners and a rotating cast of clients and potential clients. And he was good at golf, the same way he was good at rooms. Not technically brilliant, but consistently competent and socially fluent, which in the environment of a Saturday morning client game was worth more than technical brilliance. He was not thinking about Meg Calloway. He had not thought about her since the morning he made the comment. The comment had dissolved the moment he made it, like most things he said that were not important. She was a self-directed account with a $40,000 deposit in a firm that managed $40 million in assets under his name alone. She was, in the precise language of institutional attention, irrelevant. What he was thinking about, in October, was the technology sector. He had been overweight in high-growth technology across several of his largest client portfolios for most of the year. The positions had performed well through spring and into summer. He had continued adding exposure through July and August because the momentum had continued, and because several of the sector analysts he respected had maintained their positive outlooks. He had felt confident. He was not a person who felt unconfident often, and when he did, he generally moved quickly to resolve the feeling by making a decision, because indecision was something he associated with weakness. The decision to maintain and increase his technology exposure was the kind of decision that, when it worked, was called bold and well-timed. When it did not work, it was called something else. It stopped working in October. The correction started with a single earnings report from a major software company that came in significantly below expectations. The initial market reaction was sharp, the kind that experienced investors watched carefully, without immediately concluding that the broader trend had changed. Theodore watched it. He concluded that the trend had not changed. He held his positions and told his clients in a calm, well-written communication that short-term volatility in growth sectors was a normal feature of the market cycle, and that the fundamental case for the companies in their portfolios remained intact. He was not wrong to watch and wait for 1 week. The error came in the second week, when 2 more earnings reports missed badly, and the analyst community began revising its outlooks downward, in a cascade that suggested something more structural than a single bad quarter. Theodore was still not wrong to wait a little longer. Markets overreact. Everyone who manages money knows that markets overreact. The art is in knowing when the overreaction is the story, and when the overreaction is the market's way of pricing in something real. He waited. The correction deepened. He made adjustments, but they were slower than they needed to be, and they were complicated by the fact that some of his clients were already calling. When clients began calling, the decisions became harder, because they were no longer purely analytical. They were partly about managing the client's anxiety, which was a real and legitimate part of the job, but which also had a way of clouding the decision itself. He was talking so much during those 2 weeks about why the fundamental case was still intact, that he may not have been listening hard enough to the signal that the fundamental case was, in fact, changing. By the time the correction had run its course, 6 weeks later, his flagship portfolios had taken losses ranging from 14 to 22%. Not catastrophic, not the kind of losses that ended careers or triggered regulatory attention, but meaningful. The kind that required careful client communication and follow-up, and a period of somewhat reduced confidence in the air around his corner office. He handled it professionally. He wrote good client letters. He answered the calls. He made the adjustments that were now clearly needed and presented them as proactive rather than reactive, which required a particular kind of verbal skill that he possessed in sufficient quantities to be mostly convincing. But inside the office, people noticed. The kind of noticing that does not get spoken aloud, but is felt in 100 small ways. A slightly cooler tone from one of the senior partners during a hallway conversation. A question about his model that would not have been asked 6 months earlier. The feeling of being watched more carefully than usual, not with suspicion, but with the particular attention that institutions pay to someone who has recently had an expensive quarter. And then Priya, pulling the quarterly performance data for the review report she was preparing, found something that made her go still at her desk for a moment, in a way that she was careful to make invisible to the people around her. Meg Calloway's account had dropped 6% during the same 6-week period, when Theodore's portfolios had dropped between 14 and 22%. And then, over the following 11 weeks, it had recovered in full, and was now sitting at a gain for the year. Not a modest gain. A gain that, if you placed it next to the performance figures for the firm's managed accounts during the same period, did not look like the work of a retired woman playing at stocks. It looked like the work of someone who understood exactly what they were doing. Priya stared at the numbers on her screen for a long moment. She thought about her father. She thought about the comment Theodore had made at the monitor in September. She thought about Meg's voice on the phone, calm and already moving forward, and about the green notebook she had seen open on Meg's lap in the lobby, and about the way Peter Sloan had mentioned, months ago now, that he had rarely seen anyone come in as prepared as that client had been. She checked the numbers a second time, then a third. Then she printed them out, put the printout in the folder for the quarterly review, and went to get a glass of water. She needed a moment, not because she was surprised, but because she had known, on some level, since the morning she heard the comment, that this story had a direction. And now she could see where the direction led. She went back to her desk. She opened the quarterly review document. She began writing the section on account performance. She wrote it accurately and completely, the way she wrote everything. She did not editorialize. She did not need to. The numbers would do that on their own. The Vermont woods behind Meg's house had been fully gold and orange for 2 weeks before she noticed them, not because she had stopped finding beauty in autumn, which she had loved since childhood, but because October had demanded every available hour of concentration. The market, which had spent the better part of 6 weeks throwing itself against the walls of its own expectations, had finally begun to settle, and that settling had required her to be attentive, in the way she was always attentive during periods of volatility. Watching, checking, not reacting, but not going absent either. The protection she had built into her portfolio in the months before the correction was not accidental. It had been deliberate, methodical, and something she had done without anyone suggesting it to her, because she had looked at the numbers, and the numbers had been telling her something specific, for longer than most people seemed to be listening. What they had been telling her was that certain parts of the market were being valued with a confidence that the underlying data did not fully support. She had been watching a cluster of high-growth technology companies for months, with the same attentiveness she brought to everything. She had read their earnings reports, and their debt structures, and their cash flow statements, and she had noticed a pattern that made her cautious, not certain of a correction. She was never certain of anything the market was going to do in the short term, because she had read enough to know that anyone who claimed certainty about short-term market direction was either mistaken or selling something, but cautious. And caution, in her method, had a specific meaning. It meant reducing exposure, adding protection, and moving a portion of her holdings into positions that would hold their value or benefit modestly if things moved downward. She had done this in late August, not dramatically. Not in a way that required any kind of dramatic action or announcement or article. She had quietly adjusted her allocations, set trailing stops on positions she had held for a while and wanted to protect, and moved a portion of her cash into short-duration instruments that would give her dry powder if prices fell to levels that made her watchlist companies attractive to buy. When the correction came in October, she watched it without moving for the first 2 weeks. She had been through enough of her practice account experience to know that watching was not the same as doing nothing. Watching was active. You watched with your research in front of you. checking whether what was happening in the market was changing any of the fundamental data about the companies you owned. If the fundamentals had not changed, the price movement was noise. You held. If the fundamentals had changed, you adjusted. Not impulsively, but deliberately, based on what the new information actually told you. During those 6 weeks, she made 3 adjustments. She sold one position that had been hit by sector contagion, and whose quarterly report, when she read it carefully, revealed a deterioration in one of the metrics she tracked that she had not initially seen in the preview figures. She added to a second position, a consumer staples company she had been watching, when its price fell far enough that her estimated value calculation made it attractive, and she sat still on everything else. The result was that her portfolio fell 6% at its worst point during the correction. She watched the number on her screen each morning, with the attention of someone monitoring something important, but not with the anxiety of someone who did not trust the vessel they were in. She trusted the vessel. She had built it carefully. 6%, in a period when the broad market was falling significantly more than that, was not a sign that something had gone wrong. It was a sign that the protective measures she had put in place had worked. By the time the correction had run its course, and the market began its recovery, Meg's account was recovering along with it, but from a much smaller hole. And because she had dry powder from the adjustments she had made in August, she was able to buy into the recovery, at prices that were substantially lower than they had been before the correction, which would add meaningfully to her returns over the months ahead. She did the math one evening in November, sitting at her kitchen table with her notebook and a fresh cup of tea. The autumn light outside was fading early now, the way it did in Vermont once the leaves had come down and the sky began to take on the particular gray of approaching winter. She did not find November beautiful the way she found October beautiful, but she found it honest. There was nothing left to hide behind, just the bare branches and the clear cold air. She calculated her year-to-date return. She checked it twice. She sat with the number for a moment. It was good. It was better than good. It was the kind of number that, if it appeared in a fund manager's annual letter, would generate a considerable amount of positive attention. But it was not going to appear in a fund manager's annual letter. It was in her green notebook, in her kitchen, in Vermont, with no audience, except herself. She turned to a fresh page and wrote the date at the top. She started her notes for the following week's review. There was a company she had been watching in the industrial sector that had seen its price come down to a point she found interesting. She needed to go through the last 3 years of financial statements before she made any decision. She would start in the morning. She did not know yet that the same November, in which she was sitting calmly with her notebook and her returns, was the November in which Priya Okafor was preparing a quarterly performance review that would place those returns on a page next to the returns of the firm's managed accounts. She did not know that the page, when it was prepared, would make certain numbers visible to certain people, in a way that would change the next several months of her life. She was not thinking about the firm, or about Theodore Hargrove, or about any of the machinery that existed in that glass-fronted office building she had visited once in September. She was thinking about the industrial company. She was thinking about its debt-to-equity ratio and what it told her about the management team's philosophy. She was thinking about whether the decline in its price was temporary noise or a sign of something she needed to look at more carefully. Caroline called that evening. She was full of news about the children and the catering business and a new house she and her husband were considering, and Meg listened warmly and asked the right questions and laughed in the right places. When Caroline asked how she was doing, Meg said she was fine, that Vermont was cold but she was used to it, that Harriet had brought over a loaf of banana bread on Tuesday. Caroline said she was glad Meg had Harriet nearby. Meg agreed that she was glad. She did not mention the notebook. She did not mention the industrial company or the trailing stops she had set in August, or the year-to-date return she had calculated earlier that evening. She did not mention any of it, not because she was hiding it, but because she was not ready to put it into words yet, and because the conversation was not the right container for it. The notebook was the right container. The kitchen table was the right container. The long, quiet evenings in November, when the work could happen without interruption, were the right container. She said goodnight to Caroline, washed her cup, and went to bed. In the morning, she would review the industrial company. In the afternoon, she would check her positions. In the evening, she would read whatever she needed to read to stay ahead of what was coming. She had been doing this alone for years. She had gotten quite good at it. She did not yet know that things were about to stop being as alone as they had been, that a young woman at a desk in an office she had visited once was about to put a set of numbers on a page that would bring the world to her kitchen table, whether she had invited it or not. But even when it came, she would handle it the same way she handled everything, with her notebook open, her tea warm, and her eyes clearly on the numbers in front of her. The quarterly performance review document that Priya Okafor placed on Gerald Hartwell's desk in the first week of December was 32 pages long. It covered every managed account in the firm's portfolio, broken down by return, volatility, benchmark comparison, and notable events during the review period. It was formatted the way all such documents were formatted at Hartwell & Associates, clean and precise, and written in language that communicated facts without editorializing. Priya had written most of the document herself, as she had written most of it for the previous 3 quarters, with a level of care that went slightly beyond what was strictly required, but that she considered professional standard. The section on comparative account performance was on page 21. It was a table. 2 columns of numbers on a page that did not look, at first glance, remarkable. The left column listed the managed accounts by anonymous identifier and their returns for the period. The right column listed several categories of accounts for comparison, including a selection of self-directed accounts held at the firm, again anonymized. Priya had included this comparison section for the first time in this quarter's report. In previous quarters, self-directed accounts had not been included in the comparative analysis because they were considered outside the scope of what the review was intended to measure. She had included them this quarter because the review guidelines gave her discretion to expand the comparison section if doing so added meaningful context to the managed account data, and she had determined, honestly and correctly, that it did. She had included 6 self-directed accounts in the comparison. She had selected them based on account size and activity level. She had presented them with the same anonymized identifiers as the managed accounts. She had not highlighted any of them in the narrative. She had not written a single sentence of commentary. She had placed the numbers on the page and let them be what they were. Gerald Hartwell was 64 years old. He had built the firm from a 2-person partnership 28 years earlier and had watched it grow into something that employed 23 people and managed enough assets to matter. He was not the loudest person in any room, which was part of why the firm was what it was. He had an eye for things that were not performing as well as they should be, and an equally developed eye for things that were performing better than expected, and he treated both with the same careful attention. He read the quarterly report on a Tuesday morning, with the door of his office closed. He read it in order, page by page, which was how he always read it, because reading out of order gave you the impression that the document confirmed what you already thought, rather than showing you what it actually contained. When he reached page 21, he looked at the table for a long time, without turning the page. He looked at it a second time. He pulled a calculator from his desk drawer and checked one of the numbers, not because he doubted the document, but because the habit of checking was deep in him, and he indulged it without embarrassment. The number was correct. He turned the page and read the rest of the report. Then he went back to page 21. He looked at the table one more time. He noticed that account identifier SD-04, one of the 6 self-directed accounts in the comparison, had produced a year-to-date return of 28% during a period when the managed accounts in his firm ranged from a low of -11% to a high of +14%, with a weighted average return across all managed accounts of +3.2%. He sat with that for a moment. He pressed the button on his desk phone and asked his assistant to get Priya Okafor. Priya came in 3 minutes later. She was wearing her good jacket, the dark green one she kept at her desk for meetings she had not been expecting. She had not been expecting this one. She had taken a breath in the hallway before knocking, not because she was worried, because she was composed in a precise way, and composure benefited from preparation, even brief preparation. Gerald asked her about the self-directed comparison section. He asked why she had included it this quarter when it had not been included in previous quarters. She answered him plainly. She said that the review guidelines allowed for expansion of the comparison section when it added meaningful context. She said she believed it added meaningful context. He nodded. He asked her about SD-04 specifically. He asked her if she had verified the data. She said she had verified it 3 times. He asked her who the account holder was. She told him the account holder's name. There was a brief silence. Gerald did not have an expressive face in the way that some people's faces immediately broadcast what they are thinking, but there was a quality of attention in the pause that was different from ordinary processing silence. He asked one more question. He asked whether SDO4 was the self-directed account that had been opened by a new client in September. Priya said yes. Gerald thanked her. He told her the report was well prepared. He asked her to close the door on her way out. She did. She went back to her desk. She opened the client account summary she had been working on before the call. She did not look up to see if anyone had noticed she had been in Gerald's office. No one had noticed. No one ever noticed the movements of the person who prepared the documents. The document moved through the room invisibly until it arrived in front of someone with the authority to do something with it. That was how institutions worked. Priya had understood that for a long time and had stopped being bothered by it. Gerald, in his office, sat for another few minutes with the door closed. He was thinking, which was something he did without rushing, because he had learned over 28 years that the value of a decision was usually in direct proportion to how long you were willing to sit with it before acting. He was thinking about the table on page 21. He was thinking about the difference between the numbers on the left side and the numbers on the right. He was thinking about a self-directed account that had been opened by a retired woman from Vermont in September, with $40,000, no advisory relationship, no firm support, no access to the research his advisors used, no team, no infrastructure, just her own knowledge and her own method, and whatever she had been carrying around in that notebook his receptionist had mentioned in passing on the day she came in. He was thinking about the fact that she had done what she had done during a period that had been, by any honest assessment, a genuinely difficult 6 weeks for professionally managed money. And he was thinking that he wanted to talk to her, not because he felt he owed her something, not because he was moved by a story. He was a businessman, not a sentimentalist, and he had not built what he had built by making decisions based on stories rather than numbers. He wanted to talk to her because the numbers on page 21 told him something that it would be foolish to ignore. They told him that somewhere in Vermont, a woman with a green notebook was doing something that the people on his payroll, with their credentials and their software and their access to every research report money could buy, were not quite doing. He had not survived 28 years in this business by ignoring things that were not quite being done. He asked his assistant to call Hartwell and Associates account records and get a contact number for a client named Margaret Calloway. Meg was reviewing her position in the industrial company, which she had now held for 3 weeks, when the phone rang on a Thursday morning in December. The caller identified himself as Gerald Hartwell. She recognized the name from the paperwork she had signed in September and from the firm's website, which she had read carefully before choosing to open an account there. She listened to him. She did not interrupt. He was measured and polite and did not waste language, which she respected. He said that her account had come to his attention during the firm's quarterly review. He said that her performance during the review period had been notable. He said he would like to meet with her, not in the capacity of a client to be managed, but in the capacity of someone whose perspective he believed the firm might benefit from. He said he was aware this was an unusual request, and that he understood if she preferred not to meet in this way. He said he would value her time. She asked him one question. She asked whether the meeting would involve any expectation on either side that she would change the way she managed her account, or move it to an advisory relationship. He said no. He said clearly and without hesitation that the account was hers to manage however she chose, and that this would not change, regardless of the outcome of any conversation they had. She told him she needed a few days to think about it. He said that was entirely reasonable, and gave her his direct number. She sat in her kitchen after the call, with her notebook closed and her tea untouched. The industrial company and its debt-to-equity ratio would have to wait an hour. She needed to think about what had just happened, and what, if anything, she wanted to do about it. She had not started any of this with the goal of being noticed. She had started it with the goal of financial security, built honestly, through her own work. She did not need external recognition to feel that what she had done was real. It was real regardless of whether anyone at Hartwell and Associates could see it on a table in a quarterly report. It had been real when she was doing it alone in Vermont with no audience except herself. But there was a difference between recognition and conversation, and what Gerald Hartwell was offering, stripped of its professional framing, was conversation. A chance to sit across a table from someone who was looking at what she had done with serious eyes and asking how it worked. She had not had that conversation yet. The notebook had been the conversation for 4 years. The kitchen table had been the conversation. The library books, and the practice account, and the green ink in the margins had been the conversation. She thought about all the Tuesday evenings she had spent alone, with numbers that no one else was looking at, building something that no one else knew she was building, becoming someone no one else could see. She thought about Priya's voice on the phone in September, the simple human decency of the warning, and the apology. She thought about the man who had made the comment, whoever he was, sitting in that office with his certificates, and his managed accounts, and his window that faced the street. She thought about the quarter that had just passed. She thought about what the market had done, and what she had done within it, and what the difference told her about the method she had built. She made her decision on Friday morning. She called Gerald's direct number and said she would come in. She said she wanted 2 weeks to prepare, not because she was nervous, but because she had certain things she wanted to have in order before she sat down with anyone. Gerald said that was completely acceptable. They agreed on a morning in mid-January. She opened her notebook to a fresh section. She began outlining what she wanted to bring to that meeting, not to perform, not to impress. She was past performing and impressing. She wanted to think clearly about what her method was, in terms clear enough to communicate it to another person accurately. Because if she was going to sit in a room with professionals and talk about what she had done and how she had done it, she was going to do it with the same care she brought to everything. She was going to be completely prepared. And somewhere in the office building she would walk into in January, a man whose name she had only recently learned was sitting with the awareness that something had gone wrong in the past quarter, and that the quarterly report had revealed something that he did not fully understand, and that he did not especially want to understand, but that he was going to have to understand eventually, because the numbers were on the page, and he could not unread them. She did not think about him as she wrote. There was no point in thinking about him. The work in front of her was more interesting than he was. She wrote for 2 hours, then she made lunch, then she went back to the industrial company. There was still the matter of its debt structure, and what it suggested about the next 18 months. She had notes to review, and estimates to check, and conclusions to reach or withhold, depending on what the numbers actually said. Outside the kitchen window, the first snow of the year was beginning to fall on Vermont. She did not look up. She was looking at the page. The preparation Meg brought to the January meeting was the same preparation she had always brought to everything. Thorough, honest, and structured around what the information actually said, rather than what she wanted it to say. She had spent the 2 weeks between Gerald Hartwell's invitation and the meeting going through her own records methodically, pulling together the thinking behind each significant decision she had made over the past 4 years, writing it in clear language that did not rely on jargon, because she had built her knowledge outside the industry's language, and she understood things in her own terms, and she trusted those terms. She organized her notes into a 3-part summary. The first part covered her investment philosophy, which she had developed through reading and through the practice account, and which she could now describe precisely. She was a long-term value investor with a discipline around entry prices and a strong preference for companies with low debt, consistent cash generation, and management teams who behaved as though they had personal stakes in the outcome, which they usually did, because she looked for that specific signal as part of her research process. The second part covered her risk management approach, which was the part she suspected would be of most interest to a firm that had just come through a difficult quarter. She could explain exactly what she had done in August, why she had done it, and what specific signals in the market data had prompted her to act when she did. She could explain it without making it sound more dramatic or more prescient than it was. She had seen something in the numbers. She had acted on what she saw. It had worked this time. In a different sequence of events, it might not have worked quite as cleanly, and she was honest enough to include that in her explanation, because she did not want anyone to mistake a disciplined process for a guaranteed outcome. The third part covered her learning method. This was the part she had hesitated over. It was the most personal section, the part that described how she had taught herself everything she knew, what she had read, how she had tested it, how she had recorded her mistakes, how she had used failure as data rather than as evidence against herself. She had hesitated because it felt vulnerable to discuss, and because she was not certain how it would be received by people who had come to their knowledge through formal education and professional training. But she included it, because she had decided, in the end, that if she was going to have this conversation at all, she was going to have it honestly. which meant including the parts that felt uncomfortably personal, along with the parts that felt professionally defensible. She printed the 3-part summary, 6 pages total, double-spaced. She brought 2 copies in a plain folder. She brought her green notebook. She brought her thermos. She wore the same gray cardigan she had worn in September, not as a statement, but because it was warm and comfortable, and she had stopped choosing clothes based on what rooms expected of her a long time ago. Gerald met her at the door of the conference room himself. He was taller than she had expected from his photograph on the firm's website, and quieter in person than his professional biography implied. He had a handshake that was firm, without being performative, and eyes that looked directly at her when he spoke, which she noticed and found encouraging. He thanked her for coming. He introduced 2 senior partners, a man named Jeffrey Collins and a woman named Louise Frayne, both of whom were in their 50s, and carried the composed attention of people who had seen enough over their careers to distinguish signal from noise quickly. Meg looked at him once. He looked at her. There was a recognition in his expression that she identified immediately, and it told her several things in a short amount of time. It told her that he knew who she was. It told her that he now knew who she had been when he made his comment. And it told her that he was sitting with the discomfort of that knowledge, in a room where he had no clean way to manage it. She gave him nothing in her expression, except ordinary professional acknowledgement, the same look she gave Jeffrey Collins and Louise Frayne. Then she sat down. The meeting opened with Gerald giving a brief and precise summary of why he had invited her. He mentioned the quarterly performance data. He was specific about the numbers, which she appreciated. He said he had read the 3-part summary she had sent ahead of time and had found it clear and impressive. He said he had shared it with the people in the room, and he invited questions. Jeffrey Collins asked the first question. He asked about the August adjustment, specifically, what data had prompted her to reduce her technology exposure when she did. She answered him in detail. She explained the metrics she tracked, the specific signals she had seen in the earnings data, and the debt structures of several high-growth companies, and the threshold she had reached in her own assessment that had made her uncomfortable enough to act. He listened carefully. He nodded twice. He asked a follow-up question about her methodology for setting that threshold. She answered him. Louise Frayne asked about the recovery period. She asked how Meg had decided where to redeploy her dry powder as prices fell, and how she had determined the timing. Meg explained the valuation framework she used, which she had built from her reading and refined through practice. She explained the specific companies she had added to, and why the fall in prices had crossed her estimated value threshold for those positions. Louise asked whether she had considered other positions in the same period that she had ultimately passed on. Meg said yes, and described 2 that she had examined and declined, and her reasons for declining them. Louise made a note on the pad in front of her. Theodore asked one question. It came near the end of the meeting, after the other 3 had been asking for the better part of an hour and a half. He asked it in a voice that was professionally controlled, but that contained something underneath the control that Meg recognized as a person having a difficult time inside a situation they had not anticipated. He asked about her approach to portfolio concentration, specifically whether she felt the level of diversification in her account was appropriate for the size of the account. It was a fair technical question. She answered it fairly and technically, explaining her view on diversification and her reasoning for the concentration levels she maintained. She said she tracked each position carefully enough to be comfortable with the level of concentration she held. She said diversification, beyond a certain point, could dilute returns without proportionally reducing risk if the underlying research on each position was sound. He nodded. He did not ask another question. When the meeting closed, Gerald said he would follow up within the week. He thanked her genuinely. Louise Frayne shook her hand and held the handshake a beat longer than necessary, which Meg interpreted as the kind of signal that professional women sometimes gave each other when words were not the right container. Jeffrey Collins held the door for her on the way out. Theodore caught up with her in the hallway before she reached the elevator. She heard him behind her and turned. He was standing at a careful distance, not blocking her path, holding a folder in both hands with a formality that did not suit him. He said her name. She waited. He told her he owed her an apology. He said that he had made a remark in September that was unprofessional and unkind, and that it had been wrong. He said he was sorry. He did not offer an explanation. He did not offer context. He just said he was sorry, in a voice that was quieter than she imagined his voice usually was. She looked at him. She had thought, In the weeks since she had known his name and his role, about what she would say to him if this moment came. She had not thought about it often, because he was not someone she had built her life around, and the energy it would have taken to harbor a significant response to him was energy she had used for things that mattered more. But she had thought about it a little. What she had decided was this: she was not going to make it easy or light. She was also not going to make it punishing. She was going to be honest. She told him that the apology was appreciated. She told him that words like the ones he had said had weight, not just to her but to every person in rooms, like that one who was learning to take up space that the room had not offered them. She said she was not telling him that to be difficult. She was telling him that because she thought it was worth knowing. Then she reached into the folder she was carrying and took out the extra copy of the 3-part summary she had printed. She handed it to him. She said the section on risk management might be useful to him. He took it. He looked down at it. He said thank you. She walked to the elevator. She pressed the button. She did not look back. Outside, January in Vermont had sent its best representative down to meet her. A sharp, honest cold that came off the mountains, with no intention of softening itself for anyone's comfort. She walked to her car. She put the folder on the passenger seat. She sat for a moment with her hands on the steering wheel. She had been in that building for 2 hours and 20 minutes. Somewhere inside it, 3 people who had spent their careers managing other people's money were sitting with what she had shown them. One of them was standing in a hallway with a 3-page document, and something that might, if he was serious about it, change how he looked at everything. She had not come here to teach anyone a lesson. She had come here because the numbers had created a conversation that was worth having. That was all. Numbers, if you read them honestly, eventually told a truth that was too clear to avoid. She started the car. She had 2 hours of driving ahead of her. She had the industrial company to get back to. She had a position review due on Thursday. There was a new company she had found in the healthcare sector the previous week. A small one, not well known, with a balance sheet that told an interesting story if you knew how to read it. She had reading to do. The consulting arrangement came together in 3 conversations, not one, which was how Meg had known it would. Gerald Hartwell was not a man who moved on the first word, and she respected that. She was not a woman who moved on the first word either. The first conversation established interest on both sides. The second conversation established terms that were clear and written down, and not reliant on anyone's memory of what had been said. The third conversation confirmed those terms and set a start date. The arrangement was specific. She would work from home, from Vermont, using her own computer and her own methods. She would provide a written monthly analysis to the firm, covering a set of sectors she had agreed to monitor. She would be available for 2 calls per month to discuss the analysis with the senior team. She would not manage client money directly. She would not be responsible for implementing any recommendations she made. What she provided was independent research and perspective, and what the firm did with that research and perspective was their decision entirely. She had insisted on that last point carefully, not because she was being difficult, but because she understood something important about the difference between making a good decision and implementing someone else's good decision. The first was fully within her control. The second was not. If she was going to attach her name and her work to an outcome, the outcome needed to stay in the domain she controlled. Gerald had understood her reasoning immediately, which was one of the things that had made her trust him enough to proceed. The fee arrangement was fair. Not generous, but fair, which was what she had asked for. She had not come into this to become wealthy from the consulting. She was managing her own portfolio for that. She had come into it because she found the work interesting, because she genuinely wanted to continue thinking about markets and companies and what the numbers were saying, and because having a structured conversation partner for that thinking was something she had wanted for 4 years, without knowing exactly what form it would take. The first monthly analysis she submitted in February was 12 pages long. She had written it the way she wrote her notebook, in precise language, with specific reasoning behind every observation, with clear distinctions between what the data showed and what she was inferring from the data. She had not written it to sound like anything other than what it was, one person's careful reading of the available information. She had not used language she did not fully mean. She had not included any statement she was not prepared to defend in detail if asked. Jeffrey Collins called her on the second day after she submitted it. He asked 3 questions. All 3 were good questions. the kind that came from someone who had read the document closely rather than skimmed it. She answered all three without needing to look anything up. When the call ended, he said the analysis was useful, plainly and without embellishment, which was the kind of feedback she found most trustworthy. Louise Frayne sent a written response to the analysis on the fourth day. It was 3 paragraphs long and contained one substantive disagreement with a conclusion Meg had reached about the healthcare sector. Meg read the disagreement carefully. Louise was working from different data on one key variable, and her conclusion was coherent given her data. Meg was working from what she believed was a more complete picture of that variable, and she wrote back explaining her reasoning in 2 careful paragraphs. Louise responded the following morning with a note that said simply, "I think you are right, and I need to look at that more carefully." Meg appreciated the directness. Theodore Hargrove did not contact her in February. He did not contact her in March either. She had not expected him to, and she had not specifically wanted him to. What she had given him in the hallway in January was not an invitation to a conversation. It was information. Whether he used it was his choice to make. Priya Okafor emailed her at the end of February to introduce herself properly, which Meg thought showed a kind of professional grace that was becoming rarer. Priya said she had been the one to include the comparative performance data in the quarterly report. She said she had done so because she believed it was accurate and relevant, and that it deserved to be seen. She did not make herself the hero of a story. She just said what she had done, and why. Meg wrote back a response that was warm and specific, and offered to be available for a phone conversation anytime Priya wanted one. The call happened 2 weeks later. It lasted 90 minutes. They talked about the market, about the specific sectors Meg was currently analyzing, about a company Priya had been watching on her own time, because she had begun doing her own reading outside of work. Meg listened to Priya describe the company, and what she had found in the earnings report, and what she thought it meant. She asked her several questions. Priya answered them well. When she answered imprecisely, she acknowledged it without being defensive. When she was uncertain, she said she was uncertain. At the end of the call, Meg said that if Priya wanted to share her analysis on the company, she would be glad to look at it and offer her thoughts. Priya said she would prepare something and send it over. She did, 4 days later, in a document that was 8 pages long and considerably more thorough than many professional research notes Meg had seen referenced in the financial books she had read. It had gaps. Every first analysis had gaps, but the framework was sound, and the honesty was present throughout, and those 2 things were more important than any gap. Meg's response was 3 pages. She identified the gaps clearly, explained why they mattered, and suggested 2 sources where Priya could find the additional data she needed. She told her what she had done well, which was not cheerleading, but accurate observation, because Priya had done genuinely well, and deserved to know specifically how. She told her one thing she had not done well, and why, which Priya had not done, which was sit with the analysis for a week before submitting it. The instinct to complete and submit was a good one, but it was faster than the instinct to return to something cold and check it again. The cold return caught things the warm first draft missed. Priya wrote back that same evening. She said the feedback was the most useful thing she had received in 14 months at the firm. She said she was going to sit with the analysis for a week and resubmit it. She did exactly that. The revised version was noticeably stronger. A mentorship, though neither of them called it that at first, had begun. It was not formal. It did not have a name or a structure or a certificate at the end. It was 2 people who had both been underestimated by the same institution in different ways, talking about markets and companies and what the numbers said, because the conversation was genuinely useful to both of them, and because genuine usefulness did not require a title. Spring arrived in Vermont slowly, the way it always did, reluctant at first, then all at once. The trees came back, the light shifted. The kitchen table where Meg had worked for 4 years looked different somehow in the longer evening light, as though it were aware of having been witness to something worth witnessing. She had not become a different person. She had not become famous or rich or transformed in any of the ways that made for satisfying stories. She was still the same woman who drove to the library on Tuesdays and Thursdays, still the same woman whose neighbor Harriet brought too much food and whose daughter called twice a week. She still made her tea in the mornings and opened her notebook before she looked at anything else. She still researched companies alone and questioned her assumptions alone and wrote her conclusions in green ink and checked them twice. But the work that had been private was now, in a limited and controlled way, shared. The conversation she had needed for 4 years was now happening, and it turned out that having the conversation did not diminish the private work. It extended it. It made the questions sharper. It made the thinking that happened between calls richer because she knew it would have to hold up under scrutiny from people who were paying close attention. She was 53 years old and learning, still, which was the only state of being she had ever trusted. In the back office of Hartwell and Associates, a junior analyst named Priya was running her second independent company analysis through a revised framework she had built from the methodology Meg had described on their calls. She was sitting with it for a week before submitting it, the way she had been taught. In the corner office with the window facing the street, Theodore Hargrove was, according to Louise Frayne, who mentioned it in passing on a call with Meg in April, working through a revised approach to risk management in his portfolios that was notably more disciplined than what he had been doing the previous year. Louise had said it casually, as though it were an administrative detail. Meg had received it the same way. She did not find it satisfying in the way that people in movies found certain moments satisfying. She found it accurate. A person had been shown information, and the information had been useful to them, and they had used it. That was what information was for. That was always what it was for. She turned the page in her notebook to a fresh section. There was a company she needed to finish reviewing before Friday. She was about 3/4 of the way through the financial statements. The picture that was forming was interesting, not conclusive yet, but interesting. She uncapped her pen. She went back to work. By the time Autumn returned to Vermont for the second time since Meg had opened her account at Hartwell and Associates, she had produced 9 monthly analyses, mentored 1 junior analyst through 14 independent research projects, and grown her own portfolio to just over $300,000. She had taken 1 significant loss in the spring, on a position she had held too long past a signal she had recognized, and then rationalized away, which she wrote about at length in her notebook without being easy on herself, and she had recovered from it cleanly. The notebook entry on that loss was 4 pages long, and was the most precise thing she had written since the day she had found the retail company in her practice account period, and catalogued her analysis of it. She kept both entries in the front section of a new notebook, which she had started in March, because the original green notebook had run out of pages. The new notebook was also green. She had gone to the library supply cabinet in February and bought 3 more of the same kind. She was not sentimental about stationery, but she was consistent, and consistency was worth protecting when you found it working. The consulting arrangement with Hartwell and Associates had been renewed for a second year without renegotiation, which was Gerald's way of saying that the arrangement was working without making a production of it. He was still spare with compliments and direct with feedback, and she still found that combination of qualities more useful than its alternatives. Jeffrey Collins had recommended one of her sector analyses to an external contact at a fund he had a long-standing professional relationship with. The contact had written to Gerald, asking if the firm had a research department. Gerald had written back, saying that the firm had an exceptional independent research partner. He showed Meg the email. She read it once, thanked him, and moved on. Priya was, by October of that second autumn, producing research that Meg considered genuinely excellent. Not excellent for someone early in her career, excellent, without qualification. She had submitted 4 analyses since the spring that Meg had reviewed, and found to be clear-eyed, thorough, and carefully calibrated between confidence and humility. She had also begun to ask different kinds of questions on their calls, not just questions about what the numbers said, but questions about how to think about the moments when the numbers said one thing, and your instinct said another, and what to do in those moments, and whether instinct was a real thing, or just experience wearing a different name. Meg had spent a long time on that question in one of their late autumn calls. She had said that instinct, when it deserved to be trusted, was usually a pattern that your experience had learned to recognize faster than your conscious mind could explain. She said the test was whether you could eventually explain what the instinct had noticed. If you could, it was experience. If you could not, it was noise pretending to be insight, which was a different thing and considerably less reliable. Priya had been quiet for a moment after that. Then she had said she needed to write that down. Meg had said she already had it in her notebook, and she would send the page by email. She had photographed the notebook entry and sent it that evening, and Priya had responded with a paragraph that began with the words, "This is exactly what I needed," which was the kind of response that made the work feel like it had arrived somewhere. Theodore Hargrove had asked Meg 2 questions over the course of the year. The first had come in April, by email, a careful and professionally worded question about how she assessed the reliability of management team guidance and earnings calls. Specifically, when guidance had been consistently optimistic and had consistently missed. She had written back a considered response that was 4 paragraphs long and drew on specific examples from her own research records. He had thanked her briefly and said her answer was helpful. The second question had come in August, also by email, about her methodology for setting exit criteria on positions she was holding at a profit. She had answered it similarly, specifically, and without hedging. He had thanked her again. The exchange was professional and clean. There was nothing between them except information moving in one direction and acknowledgement moving in the other. She did not require more than that. It was not a friendship. It was not a reckoning. It was 2 people in a professional context, one of whom had been wrong about the other and had found a way to acknowledge it, and then, over time, to learn from it. That was not nothing. In the world of rooms and assumptions and careless dismissals, it was actually quite rare. She thought about this one evening in October, sitting at her kitchen table with her second-year notebook open, and the autumn outside doing what Vermont autumn did, making everything it touched temporarily beautiful, and completely honest about what was coming next. She was 54 now. She had been doing this for 5 years, 4 alone and 1 in conversation. The 5 years had cost her something in solitude, and had given her something in clarity, and she did not think the exchange had been unfair. She thought about Gary. She thought about his voice at the dinner table saying that everything was connected to something, and that the useful thing to do with information was to ask what it was connected to. She had asked, in her way, for 5 years. She had followed the thread every time she found one, even when it led somewhere she had not expected, even when what it connected to made her uncomfortable, even when the answer to the question was that she had been wrong and needed to adjust. Following the thread was the whole practice. The rest was just showing up. She thought about the library on Tuesday and Thursday afternoons, and the reading chair where she had read the first 3 chapters of that book by the retired fund manager, and felt something shift in the way she understood numbers. She thought about the practice account and the 8 months of invisible, unwitnessed work that had preceded every real trade she had ever made. She thought about the October correction and the way she had watched the market fall and held still because the fundamentals had not changed, and she trusted the fundamentals because she had read them herself. She thought about Claire at the reception desk and the assumption in her smile. She thought about the 2 men in suits who had walked past without looking. She thought about a lobby where she had sat with her notebook on her lap and been invisible, and about how invisibility, for a person who knew what they were doing, was not a disadvantage. It was a kind of freedom. She thought about Priya's email the previous week, which had contained a draft of a research analysis on a small Midwestern company that Priya had found through her own reading, and had spent 3 weeks examining before she was ready to share it. The draft was the best thing Priya had written so far. Meg had read it twice before responding. The response she wrote was the longest feedback she had given, because the analysis warranted it and because she wanted to be precise about what was working and why. She had ended the email by saying that she hoped Priya understood how far she had come since February, not as a compliment, but as an accurate statement of a fact that was worth having recorded somewhere. Priya had responded the next morning. She had said that she did understand it, and that she understood it because she had kept every piece of feedback Meg had ever sent her, and when she read it in sequence, it told a story she found useful. She said she had also kept the email in which Meg had first offered to look at her analysis and give her thoughts, which had been, as she put it, the email that changed the year. Meg had read that response in the morning with her first cup of tea, sitting at her kitchen table with the autumn light coming through the window at the angle it only reached in October. She had read it twice, and then sat with it for a moment, before putting her phone down and opening her notebook. She did not write about the email. She wrote about the industrial company she had been monitoring since spring, which had just released its quarterly report, and whose numbers were telling her something she needed to examine carefully before she decided what to do next. The numbers were more important than the moment. The numbers were always more important than the moment. That was one of the things that 4 years alone at a kitchen table had taught her, without ever having to say it out loud. She was not done. She had never thought she would be done. The market was going to continue moving, and she was going to continue reading it, and the work was going to continue producing what good work produced, which was not always what you wanted, but was always, if you were honest about it, what the work deserved to produce. She turned the page. There was more to write. There was always more to write. The tree outside her kitchen window had gone the deepest gold it would reach before it let go. She noticed it this time. She allowed herself one moment of looking. Then she went back to the page.